Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the Treasury yield curve and the US dollar currency index and discuss the idea of whether or not the Federal Reserve cut interest rates too soon. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, there's obviously been a lot of discussion about the rate cutting cycle. I put out a video on the rate cutting cycle, and one of the things that I said, and leading into the first rate cut is the Fed is going to be blamed no matter what, right? There's not really a great outcome for the Fed in the short term because if the long end goes up, which is what's happening, then the Fed's going to be blamed for cutting too soon. If the long end just keeps on dropping, then the Fed will be blamed for holding interest rates for too long and causing the economy to go into a downturn. So it's a tough spot to be in if you're at the Federal Reserve, and you can understand why they felt like they had to start cutting interest rates. If you were to simply look at the unemployment rate, it has been moving up off its low from 3.4% all the way up to 4.3%, and then it's actually pulled back a couple of tenths over the last couple of months. And so what we have right now is a market that is very unsure if the Fed's rate cut was justified. Now, rewind the clock a few months ago. One of the things I reiterated time and time again is that the long end of the yield curve and the dollar will likely rally following the first rate cut so long as there's no immediate sign of a recession, right? And you can actually, it's actually fairly easy to sort of understand that view because if you were to look at say, like, let's look at the 2 year yield, right? If you were to look at the 2 year yield, do you see right here? Let me switch this over to a weekly chart. This right here is when the Fed cut rates. The week of September 16th. They cut rates on September 18th. But what we talked about was that the 2 year yield was basically sweeping this prior low. And so essentially, there were a lot of people banking that there was a recession imminently occurring on the first rate cut. But in reality, what happened after this rate cut is we actually got a decent amount of good jobs data. Right now, we can debate the validity of the jobs data all we want, but the jobs data came in a lot better than I think what a lot of people were expecting. And also, real GDP continues to trend pretty high. And then the market, as we said, would have to ask itself, what's the 2 year yield doing at 3.5% if the Fed's cutting rates and the economy is still running at 3% real GDP, right? What's it doing down here? Because it was running at 3% real GDP when rates were at 5.5%. So if rates are now at 5%, wouldn't that be a tailwind? And I think that's essentially what the economy, what the market is trying to figure out right now, right? Was the move in the unemployment rate a one-off move that you're basically going to see reversed next week when we get the next, sort of round of unemployment data, the next round of labor market data, right? Does this get reversed where the unemployment rate goes up? If it does, right, if the unemployment rate goes back up to say 4.4%, it actually did something very similar in 1957. So that might be an interesting analog. These analogs never actually pan out the same way, but just to give you an idea of what could happen, if you were to look at 1957, the unemployment rate rallied from about 3.6 or 3.7% up to 4.3, had a 2 month pullback back down to 4.1, and then the following month, the unemployment rate came in at 4.4%. So I would argue that if the unemployment rate were to come in at 4.3, 4.4, 4.5% next week, then I don't think anyone's going to be able to fault the Fed for the rate cut, right? You could argue that they're just trying to get ahead of what they see coming over the next few quarters, right? They're just trying to get ahead. But if on the other hand, the unemployment rate drops again, which doesn't, I mean, look, anything's possible, right? Anything is absolutely possible. But to be honest, it doesn't really seem like the most likely outcome. I would put it at maybe like 20 to 30% odds. The reason why I say that is because if you were to like look at if you were to look at the unemployment rate and overlay it with something like initial claims, you can see that the unemployment rate, the blue line, right, it dropped with initial claims, but then initial claims are starting to go back up. So it would make sense for the unemployment rate to generally follow initial claims, which is what it typically does, right? I mean, if initial claims start going up, it's only a matter of time before the unemployment rate goes up. Now, these are monthly data points, so even if the unemployment rate went down next week and it continued to go up next year, I don't think anyone's going to even look at that blip on the chart. But this is the issue for the Fed, right? Is that they cut interest rates 50 basis points, and right after that, we've just gotten a lot of great job data, right? And I know the Fed is probably thrilled to see the job data okay, but what the Fed is likely not thrilled about is the long end of the yield curve. Because ever since they cut rates, the long end of the yield curve continues to rally, right? The Fed cut rates here in mid-September, and ever since then, the market has said, "What are you guys doing?" Right? If there's no recession now, in obvious to the market, then the yields have to go up, right? You can't justify it down here if rates are dropping and the market starts to worry about growth over or too much growth over a slowdown. You could argue that sort of leading into the first rate cut, the market was worried that the economy was really starting to slow down, but then now that you got the rate cut and you still have GDP holding up okay, there's only one direction for the long end of the yield curve to go until you start to get more data to suggest otherwise. So, one important thing that we have to point out here is that the last 2 years, the long end of the yield curve actually topped in October, right? You can see in 2022, it topped in October, and then in 2023, it topped in October. So we can't deny that there is a chance that the long end of the yield curve simply tops in October like it did the last 2 years. The counterpoint to that is that there are actually a lot of parallels with this cycle and 2016 in terms of some of the risk assets that we follow on this channel quite closely, right? Bitcoin, Ethereum, right? I just did the dubious speculation video on Ethereum, and it looks a hell of a lot like 2016. But the interesting thing about 2016 is that the yield curve got a strong rally that did not top until December. And then it finally faded until September of the post-election year, right? So the rally started in July, but then it really picked up in October, hung out up here for a couple of months, and then eventually came down. Now, rates were a lot smaller back then, or were a lot lower back then, but that is something to at least keep in mind, is that it's not like it has to top in October. There's a chance that it continues to go up. What would cause a long end to top in October, right? Well, what's something that could cause that? Well, again, if the unemployment rate comes in extremely hot next week, far above what people think, then that might be enough to cause the long end of the yield curve to top. Because then the long end is probably going to say, all right, the Fed was justified in their rate cut, and the market just didn't want to believe it, and now, well, they're about to believe it, right? So I think a lot of it depends. I mean, even the price of Bitcoin, right? A lot of this stuff is going to depend on the labor market next week, because this is what Bitcoin does every single time. Every time it rallies sort of in the middle part of the month to the top of this trend line, hesitates, and then once you get the unemployment rate in the beginning part of the month, it has fallen off because the unemployment rate has been dropping. Every single time, right? Comes up here, hesitates for a week, and then rejection, right? It came up here, and now it's hesitating. And I think it's waiting on this, right? I think it's waiting on the unemployment rate to see what happened. You know what changed that caused these lower highs by Bitcoin? Look, this is when the unemployment rate started to go up in March more aggressively. the unemployment rate was going up before that, but it was starting to go up in a nonlinear fashion in this range, right? Which is why Bitcoin, I think, was putting in, and has been putting in lower highs. Now, Bitcoin saw the unemployment rate dropping, said, all right, it's time to rally back up to the top of the range and then wait and see if this is a new trend, if the Fed cut when, to sort of prevent a further downturn, or if the Fed's late to the party and the unemployment rate's going to keep on going higher. If the unemployment rate keeps on going up aggressively like this, it's more likely that Bitcoin just gets rejected again. If it keeps on coming down, that might be enough fuel for Bitcoin to break through. A lot of what's happening right now is yield curve normalization. If you look at the yield curve, um, I thought I had it up over here, but yeah, if you look at the yield curve right here, and you sort of go through the cycles, right? If you sort of go through the cycles, you can see that there's periods where the yield curve inverts, like it is right there in 2000, and then at some point it uninverts and normalizes, right? Same thing happened over here in 06 and 07, right? Yield curve inversion and then uninversion. And then even in 2020, right? I mean, there was a yield curve inversion in 2019, right? And then it normalized. And now we've had an inverted yield curve for a while, and we're starting to see that normalization, right? The 2-year used to be higher than the 10-year, right? You see that? The 2-year was up here, the 10-year was down here earlier this year, and it's been like that for a while. But now the 2-year is lower than the 10-year, so the 2-year has already uninverted the 10-year yield. See here? The 2-year is already uninverted the 10-year yield. And it was during that uninversion process, that's where ETH actually got a big drop in August. Remember, in 2016, Ethereum dropped in April, August, December. Those were the major lows. April, August, December. In 2024 so far, it's been the same thing for ETH. April and August have already occurred, right? You have your April low here. Here's the August low. Same thing happened in December. In 2016, right? Your April low, your August low, and then your December low. I think you're seeing something very, very similar happen again. And this drop by ETH occurred during the uninversion of the 2-year and the 10-year. So a lot of people keep asking me, Ben, Ben, well, why do you think there's going to be another drop in December for Ethereum? Like what's the catalyst for it? I think a lot of it could just be the uninversion process of the 3-month and 10-year yield. It doesn't necessarily have to mean like recessions immediate, right? Sometimes it takes a while. There's still a chance you get a soft landing too. But it's sort of that fear of why is the yield curve uninverting? What's interesting is that recently it's actually been uninverting more so as the long end rallies rather than the short end drops. So a lot of times what happens is the short end is dropping, and because the Fed's aggressively cutting, because they realize they waited too long, and therefore the 3-month would uninvert the 10-year. Right? But in this case, you're actually seeing the long end go up a lot to basically where the short end is. And the short end is likely going to keep dropping because the Fed's likely going to keep cutting. So I would say if the unemployment rate is manageable for the market when it comes out next week, I would argue that the long end could still go up. What I would speculate, like again, if I were to just dubiously speculate what might happen, I would assume that following the unemployment rate print, you'll likely see, at some point, it could even be just before it, sort of some de-risking on this idea, or just after it. But my guess is that, it's moving up. Maybe it sort of rallies back up to this, But I'm going to guess that it gets a pullback at some point while the uninversion of the 3-month and the 10-year yield is happening. And it could be during that process. But as long as the market isn't too spooked, you could just continue to see it rise even more. I would say there's probably at least a 30% chance that the long end tops in October, because that's when it topped in 2022. that's when it topped in 2023. I think the scary thing for the market could be that if it doesn't top in October, and then that's sort of the, the old, oh crap moment, like, where is it going to go, right? Has the Fed begun the rate cutting cycle too soon? And now is the long end of the yield curve going to do what the Fed was unwilling to do? Now, it was the long end of the yield curve, this expectation that it would rally after the first rate cut, that made me think that the dollar would rally after the first rate cut. Because again, if you overlay like the 10-year yield with the US dollar, they've actually been highly correlated for a while now, right? You see that? They've been very highly correlated for a while. And so what we were talking about was that there's a lot of people that are very bearish on the dollar down here in September and calling for it to crash. Most of those people are also calling for alt season like they have been for the last 3 years. I warned them not to do that. Of course they want the dollar to crash because they keep calling for alt season. But I don't think they were looking at the market objectively, right? Because again, you can't have it both ways, right? You can't have the dollar collapsing while the Fed is cutting rates if the economy's okay, right? So if the economy's not okay, then you don't get alt season. If the economy is okay and the Fed's cutting, the dollar's probably going to go up, not down. So I think that was sort of the biggest thing that a lot of people missed is they wanted to have it both ways, right? They wanted the dollar to crash, but while the Fed was cutting, but while they wanted the dollar to crash while the Fed was cutting, they thought that meant alt season would occur right away, which doesn't really make a lot of sense. I mean, if the Fed's cutting prematurely and there's no obvious signs, then you could easily see, and this is what I said, right? The dollar would most likely bounce because the long end of the yield curve would bounce unless there's an obvious and immediate sign of a recession. What I would guess will happen with the dollar is there's going to be probably a large pullback at some point, either late October, early November. But I think it'll likely continue to go up. It did something very similar in 2016, in fact. If you go back and look at 2016, sort of during this final big push, there's a big move by the dollar starting in October, and then sort of late October, it got a drop. And then in early November, after the labor market data came in, it then continued to go up. And then it topped in December of 2016. So I think something like that might happen, right? Where it does something like this, pullback, and then another move up into the end of the year. So I could see something like that happening for the dollar. Remember in 2016, when the dollar rallied, starting in October, it rallied about 9%. And so far, it's already rallied about half that, right? I mean, it's already rallied about 4.5%. If it were to rally 9%, that would put it all the way up at around 108, 109 or so. So just something to keep in mind as it relates to the yield curve and the cutting cycle and whatnot. So that's where we stand right now. That's where we stand. And as it relates to things like TLT, this is sort of the, as they say, right, if you're an optimist, you buy stocks. If you're a pessimist, you buy bonds. As it relates to TLT, if you have a position in this, normally what happens with things like TLT, right, you can see this kind of the same pattern of setting a high and then sweeping the high and then going back down, right? I think that's what's happening right now. But I will say this. I think that there's a higher probability this time that it could double bottom, could put in a higher low, and then go back up. And it could sweep this low, but I don't think there's going to be another major move down, at least not this early, right? So some of the potential outcomes for something like TLT could be, it could be sort of like this, where then it goes back up in 2025. I could see it coming all the way back down here, sweeping that low, and then going up. One of the things about TLT that you'll notice is that a lot of times it sort of likes to sort of double bottom or sweep a prior low before then going back up. And then sometimes it'll actually go put in a slightly lower low, right? It made no sense to be bullish on TLT back over here. And the people that were bullish on it thought the terminal rate was much lower than 5.5%. I said a long time ago the terminal rate would likely be 5.5%, and that the things like TLT would likely go down into the 80s. actually. And I said for like, if you're on ITC Premium, I probably said for 2 years that TLT would likely bottom around 80 or so, somewhere between 80 to 85, I believe is what I said. And then it ended up bottoming out around 82. I mean, look, structurally, I think this is going to be the low region for TLT, but there's always a chance the long end of the yield curve rallies back up, causing TLT to drop, and then you get a move up in 2025. That's essentially what happened, in 2016, right? You can see that TLT had a big drop in Q4, came back down really close to the prior low. See that? It didn't actually set a new low, and then it started to rally. It then eventually swept the low, and then it finally moved up. But you can see that from this low in the pre-election year from 2015, that essentially served as the low for the next several years. The only time you wicked below it was very briefly at the end of 2018, also in Q4. And then you didn't really go below that until many years later in 2022. That essentially served as the low. And so I think for TLT, this will serve more or less as the low. Worst case scenario, in my view, in the short term, is that you could sweep the low if the long end goes back up to where it was previously, right? If you look at 2016, you can kind of understand what I'm talking about, right? Even if we pull back up the 10-year yield, you look at what happened in 2016, back over here, right? You can see the dollar had a really big rally where it sort of came back up to that high. It didn't make it up to this high, but it had a really big rally. So, look, I mean, it's possible that the 10-year yield could take TLT, or it's possible the long end of the yield curve could cause things like TLT to go lower for a little while, but I think probably it'll, the 10-year yield will turn around durably in early 2025. I think another reason that the long end is going up is because, like, the Fed has started to cut, and they've started an aggressive cycle because they started with a 50 basis point rate cut, which is not the norm unless the economy is not looking so great. And now I think the market is just like, what are you guys doing, right? Why are you cutting so aggressively when real GDP is still trending above 3%? Because again, I know the unemployment rate looks kind of scary. It looks a little scary with it moving up as quickly as it has. And the reality is it's likely going to structurally go higher for a while, right? But one of the main reasons that it's gone up as much as it has is actually because of an expanding labor force, more so than layoffs, right? That's one of the main reasons. Like if you look at the unemployment rate, job losers, while it's going up, it's going up in a somewhat predictable manner, right? It's a linear move. It's predictable. The steady slope. It's not like this where it's just skyrocketing, right? And going absolutely parabolic. What is going somewhat parabolic is the unemployment level for new entrants into the labor force. You see that? You see how much quicker that's moving up than it is for people like losing their job? So the reason the market, I think, hasn't really cared is because, yes, people are getting laid off, but it's not as bad as what we saw, in these parabolic moves. The main reason the unemployment rate's going up is because new people are entering the labor force and they can't find a job. And the reason they can't find a job is because hires are down so much, right? Hires have dropped a lot. So no one wants to hire people, or a lot of people, a lot of companies don't want to hire people. And also a lot of employees don't want to quit. Like the quits rate has fallen back to where it was in 2015. People don't want to quit their job because they know the company down the street probably isn't hiring. So you have a very sort of stagnant labor market where the people that have a job just want to hold on to that. The people that don't have a job are having a really hard time finding one. So the unemployment rate goes up because of an expanding labor force. But because it's not because of the layoffs, you can't, the long end of the yield curve and the dollar are not that concerned about a recession just yet. Now, at the end of this whole cycle, that will likely be the eventual outcome. But as I've said for years, the business cycle can take years. And yes, you could have a recession at any time, but it also could still be a little ways off, right? It's impossible to know. And so you got to have a strategy no matter what, right? You can't just pretend that you do know because no one really knows. Um, my guess is that there will be some form of a scare around the uninversion of the 3-month and the 10-year yield, just like there was a scare around the uninversion of the 2-year and 10-year yield, right? There was this scare around the 2-year and 10-year yield. You'll probably see something similar around the uninversion of the 3-month and the 10-year yield. But as long as, what have I said for years? As long as initial claims are below 300K, it's premature for the recession call, right? Once this goes above 300K, then you pay attention. If you look at the recession risk dashboard, the risk levels are still relatively low, right? The only risk that's really high right now is interest rate risk, but that one leads by years, right? I mean, that one can lead by years, and it's only really, once this starts to come back down, usually. I mean, there are times where the recession starts sooner, but it's usually once it starts to come back down, that's where it actually, you get your recession. But here's a good example in 1998 where it came back down. I think a lot of people thought there was going to be a recession, and then there wasn't, and then there was 2 years later, right? So again, this cycle can take a long time to play out. And I think you sort of have to respect that. You have to sort of respect that the business cycle is much bigger than a lot of people think it is, right? It takes years to play out. Absolutely, it takes a really long period of time. So we will likely see the normalization of the yield curve over the next several months, right? Could even be, just a few months, and it's completely normalized where the long end is higher than the short end, because right now, the 1-month treasury yields at around just below 5% because that's where the Fed funds rate is. But good chance the Fed funds rate is going to be at 4.5% in 2 months at the very least. And it could be lower than that, right? And if the long end continues to rally like it has been, then you could see it normalize relatively soon. My guess is that full normalization of this yield curve will be complete likely in 2025 is my guess. We're sort of seeing that process play out right now, and parts of it have already normalized, but it will continue to normalize. And if you look at the uninversion of the 2-year and 10-year yield, it actually took about 25 months from July 2022 or 26 months, I guess, till September of 2024. 26 months. If you look at the 3-month and the 10-year yield, it inverted in October of 2022. So when would 26 months be, right? It would be December of this year, which is precisely when the long end of the yield curve could top out if we don't get a recession between now and then. You see that, right? I mean, because again, that's when the long end sort of had a local top in December of 2016. What if it just does the same thing over here? Maybe a little bit of a pullback at some point, and then a rally up into December, and then it sort of fades back down. I could see something like that happening. And again, as far as the dollar goes, my expectation, I mean, I told you guys to expect a really strong rally by the dollar. It's up to 104, right? I mean, there's going to be a pullback at some point, okay? Absolutely. But I still think it's more likely than not that it's going to go up, right? Maybe it goes up, gets a sharp pullback around the release of the unemployment rate data, and then continues to go up into the end of the year, and then drops in early 2025. That's essentially what happened in 2016, right? Big rally by the dollar, and then it fell off in the post-election year, or for my crypto degens, the post-halving year. So let's see if it plays out the same way. We'll be following it. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. I know a lot of this stuff is boring, but I think it's really interesting to understand sort of, how the market works. It sort of answers the question for people of why alt season has not happened, what it would take for it to happen. And let's just see where this goes. Likely with the dollar rallying, as you guys remember, I would be remiss if I didn't point it out at least once. With the dollar rallying, what does that mean? Unfortunately for my for the altcoin season callers among us, the dollar going up usually means Bitcoin dominance is going up. And that usually means that your altcoin, or at least sorry, not your altcoin, everyone else's altcoin. It means that everyone else's altcoin is likely going to bleed back to Bitcoin, as they have been for a long time. But hopefully your altcoin is the one that is okay, and is one of the few that do okay against Bitcoin. But collectively, the altcoin market should bleed, as it has been essentially since September of 2021, once it became apparent that the Fed was going to have to go through an aggressive, well, really, I guess since January 2022, once it was apparent to the markets that the Fed was about to embark on a very aggressive rate hiking cycle. And here we are. And dominance should go to 60% by the end of the year. As the dollar goes up, topped by the end of the year, likely see the long end of the yield curve top by the end of the year or early January at the latest. And then we get back to what we normally see in post-election years. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. Again, check out Into the Cryptoverse Premium at intothecryptoverse.com, and I'll see you guys next time. Bye.